Well, thanks so much for the kind intro. Amazing. I think it couldn't be a better time to talk about this because after what we've seen, a horrible, horror few months. We had October 10th, we had November, we had January again, and yesterday, right? So where is this going, right? So my name is Ariel Navarro, CEO of Well Capital. And I couldn't find better people to talk about this than the guests that I have here. They're going to introduce themselves much better than I do, and then we can kick off, all right? But thanks for making the time for being here, because I know that you guys are getting hungry, so we keep it entertained.
Good morning. Thanks, Ariel. Hi, everyone. My name is Siedentopf. I'm the founder of CRS Advisory. Started a company about a year and a half ago. I connect hedge funds across various strategy buckets with allocators. And I'm here this week in particular representing the Fred Pai family office out of Bermuda. Fred Pai, some of you might know, he's the founder of 3IQ. And he's now running or he has been running for about 8 years, a directional strategy. Interesting time for directional strategies. And we're launching a private fund as we are reshaping that strategy in a little bit more active mandate, as well as developing a multi-strat investment manager.
Thanks, Ariel, for the introduction. I'm Quim, Allard, CEO and co-founder of Iqana. We are a fintech specialized in developing quantitative trading models for family offices, quant hedge funds, and asset managers. Dollar-denominated strategies, directional, market neutral, but also Bitcoin-denominated strategies, where we see a huge opportunity. It's a pleasure to be here. Thank you.
Oh, hi, everyone. My name is McLean, and I'm portfolio manager at GreenRam Capital, which is a single-family office. We have a multi-asset portfolio, and crypto is just one of the tools in the toolbox we use to generate returns.
Thanks so much. So let's kick it off. There's always debate on what's really moving the market, right? And a lot of people thought, when I started on this, there was a thesis on fundamentals, and that seems to have changed or not, right? So I guess to set the stage, I'd like to ask the guests, what are really fundamentals in crypto, right? Because traditional assets is very clear, right? You have revenues, you have projections, right? What are really fundamentals and what are really flows, right? So I think, with everybody's having the same understanding, that we can have a much informed conversation.
Sure. Let me kick it off. Super interesting panel, I think, for a very interesting period that we're currently in. I think fundamentals have totally gone out the window, and currently we're just trading on flows. That's kind of the short answer. But really, there's a huge discrepancy between fundamentals and price action. I think if we kind of look back at what we've seen in 2025, as an industry, we probably got everything delivered and more that we could have wished for at the beginning of the year. Same if you look at some of the ecosystems. Let's take Ethereum, for example. The TVL is just going up and to the right. It seems to be the chain that's grabbing a lot of the tokenization attention. All the right players, all the big players are building on Ethereum. By the way, that's not investment advice. It's just an example. But the price action is going completely the other way. So I think we'll talk about flows in a minute, just to quickly define fundamentals. And that's actually what got me excited about the space in the first place around 5 years ago, is what's the utility of the individual ecosystems, the utility of the blockchain. Then you got to look at the tokenomics. If it's revenue producing, great, because those are the models that we use in equity to value value projects. And then what's the distribution of the token? Is it inflationary? Is it capped? So there's many different tools in the fundamental analysis toolbox. But I think, to be perfectly blunt, if you look at the market right now, that's all gone out the window.
Yeah, totally agree. In general, I'd separate the fundamental view on three main axes. So the first one would be Bitcoin. That's a weird animal sitting apart. The scarcity of the asset, the security of the network, the ability to settle globally without an intermediary would be a fundamental thing. And also the new type of adoption, institutional player entering. That's something we're going to discuss it later. Then layer one, so other types of projects fully aligned, the TVL, the revenues, the value captured by token holders is all the clear fundamentals. And then we have also things related to market structure. So the types of products that we have deep liquidity, we have a more mature execution, custodians. So it's something that also are great fundamentals, and regulatory clarity is something that's really helping. And flows, of course, very driven by ETFs that we've observed since 2024 launch, but also derivatives, open interest, and we are really seeing that is what's moving right now the market.
I guess I would think most people don't realize digital assets even have any fundamentals. You know, most traditional finance people, which control most of the capital, don't believe that the same metrics apply. You know, cash flows, you know, or total users is very different. So applying fundamentals doesn't really work. So it has to be driven by flows, and it's very sentiment driven, very news driven. But that creates also the opportunity. And most markets aren't driven by fundamentals. A lot of things get out of whack, and that's where managers can create returns.
I think we have sort of an agreement here that at the time being, fundamentals seem to be moving the market. So, and Brendan, you said it also, bonds seems not to be also, they don't have the fundamentals, although obviously they have the underlying on the ability of the company to pay back that debt, right? But crypto being crypto, and what we've seen, the price action that we've seen, has it become a casino? I mean, if we're just betting on flows or where the flows are going to go, you mentioned ETFs, right? We have derivatives, you have people trading on perps like 100x, right? What is this?
Look, I think the casino analogy is there for a reason. I mean, there's obviously a lot of momentum and a lot of scams, a lot of attitudes around making the quick buck. But I kind of want to tie it more into a macro level of flows. I think we need to be very realistic here that October 10th, in my view, was probably more devastating to the industry than FTX, purely because it hurt retail in such a way that I mean, people got leverage when they only had 1.5 got priced out when they only used 1.5 leverage, and retail got hurt so badly that we've been missing that for a while now. And I think ETF flows and the DATs over the course of the last year, they've kind of just masked the problem. And now that we're coming into a little bit more of a volatile geopolitical macro environment, institutions are taking a slow step back and kind of uncovering the lay of the land there. That's really quite devastating.
Yeah, absolutely, and we've observed. Well, crypto has always had the tag of being a casino, and I think we are seeing that some of the assets are becoming much more institutional, like Bitcoin, Ethereum. But we still have a part of the crypto casino where we have DEXs with 100x leverage, where retail is going full degen, and this is something that has really hurt the industry in some way, because those people don't have the financial literacy to really understand what they're doing. But also we've seen that this crypto casino has fragmented liquidity a lot. So pump.funds and all those platforms where we've seen hundreds and thousands and tens of thousands of token being launched, people buying those and losing it all through rug pulls. Those has sucked a lot of the liquidity. So we are seeing a bifurcation, and I'd say retail has not been really present this cycle, much less than the rest of cycles, 2017 or 2021, and we are seeing a decoupling from Bitcoin and the rest of the market. So generally the market used to behave starting with Bitcoin flows, Ethereum, large caps, small caps, and this rotation, and this time I'd say the casino has had a smaller part, but still pretty intense. But the market is really bifurcating into the more institutional segment and the casino.
Yeah, I guess it still is a casino. The volatility is too high, but nevertheless, that's why people get into digital assets, to make as much money as possible. But it does deter more institutional investors that generally don't have any upside. If Bitcoin doubles, generally you don't get any benefit, but if it declines in price by 50%, your job could be in jeopardy. So there's a lot of career risk to playing at the digital assets casino, particularly for big investors.
So thanks, Brendan. I just wanted to pick up on your last point, right, which is the upside that you actually have or potentially could have in crypto. It's why people get into crypto, right? You obviously have the downside, which is why people don't get into crypto, right? For more institutional clients, what do you think the industry is missing to get there, right? Is it governance, right? I mean, there's a lot of conversations around where am I actually investing? Am I investing in a foundation? Am I investing in an equity corporation that is in Bermuda, right? Who's getting access to that on the flows? So what is that you think the industry as itself, right, needs to get to being a real asset class where institutional investors can invest, not just people that just want to make hundreds of billions or...
I think it's more stability, because institutional investors are generally extremely slow at investing. For instance, they might have a quarterly trustee meeting where they decide on an asset allocation, and then the next quarter they'll decide on something else. But over that time, you know, digital assets can like decline in value too materially, and it makes people nervous. You know, if you're going to allocate and you've lost half your assets, why bother? Why take that risk? Particularly because you won't allocate that much. You'd be better spending time on other assets that you understand, you know, such as private credit. It's very easy. Same with private equity. And I think it's just the volatility deters allocators, because depending on what time they'll allocate over their like investment cycle, they'll be quite badly burned. So it might not be worth it to many of those slow-moving investors.
I think in order to your point, in order to stabilize the price or maybe make the volatility a little bit more manageable, you need bigger derivatives markets, right? And the liquidity in the option markets and the derivatives market, again, I'm going to come back to October 10th, because maybe at the time it only seemed like an isolated event, but ultimately market makers, you know, larger players on the derivative space, they all kind of disappeared. And then on top of that, we had distractions with the run in commodities, right? With silver and with gold. Put on top of that the AI trade, and suddenly there was very little capital in crypto, and you need that in order to manage the volatility better. And look, I agree with you. There's always a discussion for institutional allocators: am I risking my job here by allocating into this asset class? But I think to your point, what institutions need, I think all the building blocks are now in place. Over the course of the last year or two, you've got great now custody solutions, you know, with off-exchange settlement and all the things and tools that institutions are used to from traditional asset classes. And on top of that, the regulatory environment couldn't be better, right? So I think it's just been, it probably could be classified as a black swan event, kind of a perfect storm. But needless to say, or maybe it's quite hard if you look at the price action, but I'm actually extremely bullish because of, if you look past the noise, the underlying, the way that the stars are aligning couldn't actually be better.
Yeah, fully aligned, and I think to get exposure to those types of more volatile options, generally professional investors, institutional investors look for systematic solutions or more structured products, because getting spot exposure to some of those tokens that could dump 80% overnight can be too risky for them. And right now we are seeing that there's really not the liquidity in the markets to get exposure to those sophisticated product strategies at scale. There's no liquidity, there's no order book depth. October 10th, it was already low this cycle, because not having retail in place that's gambling in the casino, filling the order books is something that we've seen had an impact. But after October 10th, liquidity fully disappeared. If you go away from the large caps, there's almost no liquidity in the market, so it's almost impossible to get exposure to those tokens for real institutional investors. So we are seeing those are really focusing to the basics, to Bitcoin, Ethereum, maybe the Solanas, but volatility needs to diminish. It was on a good way until maybe October 10th or yesterday. We are going to see how that's going to evolve.
Yeah, I think you're absolutely right. Chris, you mentioned something interesting, right, that you sort of alluded just passed by, right, which was, you know, the trades, right? So we've seen gold, silver, just having massive returns, right? AI having massive returns too, and that's those were the kind of returns that people were looking at when they were looking at crypto. Two questions here, right? Are people investing into this because it's an attention asset? So, you know, you always get the returns, and people are following the returns, right? And why should anybody in this room or anywhere else, right? If they have equity with a proper structure or silver or an ETF, right, be thinking about investing in crypto.
So kind of want to tie it back to what we talked about, volatility. You've mentioned silver, you mentioned gold. If we talk about equities, you can talk about Tesla, you can talk about Nvidia. I think they're actually all in the same bucket from a volatility perspective, same as Bitcoin. With regards to attention, I think diversification is probably the key word here. Institutional allocators, like I alluded to, have all the ingredients now to allocate to this space. You got to have conviction. And with regards to fundamentals and flows and the period that we're in right now, I think, diversify across a directional portfolio, which I like to compare to kind of liquid VC. This space offers you a lot of opportunity, but you got to have the right investment horizon, right? If you want to invest in crypto, but you're limited to only 6 months, then you got to look at a different product, maybe something that's market neutral. But if you believe in the space and your investment horizon is 3 to 5 years, then the upside investing in this space is huge. And I think just breaking it down to our title, fundamental and flows. Fundamental is kind of the starting point. It kind of ties in what we're doing at Qapture. It's the thesis around which ecosystem we believe in is going to benefit from tokenization, from DeFi, and from the intersection of crypto and AI. And then with regards to flows, that's as an active manager, you can also balance those risks and look for opportunities.
Absolutely. We've seen that the last few months, even years, commodities like gold and silver went on massive rallies. Also, the AI companies went, well, I wouldn't say maybe a bubble, but also huge rallies, bringing volatility levels that were more the ones that investors were trying to look in crypto. So a lot of people is really asking themselves, why should I invest in crypto if I can't find those types of returns in gold and silver or in equities where regulation is clearer, where governance is clearer, where we have a lot of checks that maybe in crypto are not there yet. But I would look at this as a complement to the portfolio. So betting on crypto is betting on the future of financial infrastructure. And we are seeing that this is also something that helps provide higher Sharpe ratios in portfolio, higher diversified, more robust, and entering in moments like now, especially where we are seeing huge opportunities due to the current price action and drawdowns, can be something that provides a very asymmetric opportunity, especially as Chris said, if you look it in the right time horizon. So fundamentals are really building quietly in the background. So in terms of regulatory tailwinds in the States, we are getting MiCA in Europe. So we are having the foundations for this to be an institutionalized asset class. So betting it right now in a 5 to 10 year time horizon is probably, and this is not financial advice, of course, but a very good bet. And we are seeing a lot of family offices, institutional investors that really are very curious and are starting to incorporate these portfolios, even if it's 1%, 2%, 5%, but they start to want that type of allocation because you are betting on AI for the growth, for the multiples, for the EBITDAs. You are investing in gold and silver to hedge the geopolitical risk, the currency debasement. Crypto is something different. You are betting that this will transform the financial industry. It's already happening. We are seeing tokenization. We are seeing Bitcoin. Well, I wouldn't say acting as a reserve, but it generally behaved pretty well in the last geopolitical uncertain events. So I'd say that incorporating it into portfolios will probably be a good bet for the long run.
Yeah, I always find it funny when Bitcoin gets compared to gold, because gold is like more of an older style asset. Traditionally, older people would allocate to it. Digital assets, younger people. But gold did much better. And ultimately, there's no real fundamentals with gold. There's some macro tailwinds that create a lot of positive sentiment. And that's similar to what happens to Bitcoin. You just need some momentum, and then it just snowballs. And before you know it, you can go up a lot. But in terms of portfolio construction, you just need a lot of return drivers. And that's why, people allocate to different asset classes. But in terms of, fundamentals, it shows you that it's not just digital assets that have questionable fundamentals. It applies through many different assets, and they can still rally and perform well and generate, meaningful return.
Yeah, I wanted to pick up on your last point, right? Comparing digital assets, Bitcoin in this case with gold, and there's always been that analogy, right? So people kind of really clear in their mind, or at least that's what people think, right? That there's an analogy there, right? Now, when you invest into digital assets, we talk about tokenizations and probably stable coins, what are you really investing in? How does it fit into a portfolio? Is this just technology play? What is it, right? It's interesting to hear your voice.
Well, look, I mean, I think we all know it should fit into the alternative bucket, obviously, but I think the lines are a bit blurred in crypto between VC and the liquid spectrum, because you've got the whole characteristics of token and investing into tokens. But I think you got to zoom out a little bit, and my colleagues have touched upon this. Tokenization, the whole financial infrastructure as we know it is moving on chain. And this is not just some crypto bull on a panel saying this. This is Larry Fink saying it. I mean, you got the DTCC saying they're going to tokenize their book of quadrillions of assets. So it is happening. So I think you kind of take a long-term view, a long-term bet. I would compare to a liquid VC style bet on the ecosystem, on the imminent future of the financial infrastructure. And then you can trade the cycles more actively, and there's plenty of plenty of options out there how to navigate the different phases of the market cycles.
Yeah, I would again separate Bitcoin from the rest, and for me, Bitcoin and some traditional finance investors are not going to agree with me, but I see Bitcoin more as a digital gold. It's a different animal. It's fully decentralized. There's no one that's controlling it. It's not linked to politics. It's not linked to any country. So it's for me, it's more similar to digital gold. It's still in its infancy. It's a teenager. It's 16, 17 years old, so it's not a baby anymore, but it still has a lot to prove. But the network has been 100% uptime for the last 17 years, so I'd say this is already a lot. And if you watch its behavior, it's a very scarce asset that's trending up with time because demand is increasing, but supply stays fixed. Gold supply is still increasing. Bitcoin is a deflationary asset. So I would put it in that basket. For Ethereum or all the rest of crypto digital assets, for me it would be more like technology infrastructure plays, maybe more in the venture capital space, very asymmetric bets, but there's a lot of projects that still lack the quality, still lack the fundamentals, still lack the real utility and value capture. But Ethereum, for example, for me, I've been a very Ethereum bull for the last years, not in terms of price action, but in terms of the utility. I really see that it's something that will add a lot of value to the financial industry, and I would classify it also in the alternatives, but as a technology play or infrastructure, very different to Bitcoin itself.
Yeah, I guess for us it's more the flows. I mean, if large institutional investors change their strategic asset allocation to have even a few % into Bitcoin, it can create a lot of demand and a good floor for the price. It's quite similar to the gold. With gold, you have a lot of central banks just buying it up as reserves. And if big investors start sort of applying that sort of strategic principle and will buy it regardless of price, it will over time increase the value of it, which is why we're expecting that consistent flow to come back to Bitcoin and generally provide returns over the long term.
And I wanted to add something. We are seeing a lot of institutional investors that are really interested in buying this Bitcoin position start accumulating. But as Bitcoin is not generating a yield itself, people are looking to complement the Bitcoin accumulation with Bitcoin denominated strategies to generate yield on Bitcoin and to keep accumulating more Bitcoins. We are seeing this trend that's growing, and we are seeing people that are really shifting to this mindset. I want to build a Bitcoin position for the following 10 to 20 years. So it's not something I'm trading or speculating with. It's something I'm keeping my portfolio for the long run. And as it's a very scarce asset, I think this will translate into price action. So very, very linked to the flows mechanism.
Thanks for that. I'm mindful of time. Just one last question for the panel. It seems that at this point, the flows are what pretty much dominating the market, right? why should anybody or an institution, right, be thinking about this and offer it to their clients?
I think the current period offers opportunity. I say that with very high conviction. I think the ground or the infrastructure, as I alluded to, has been laid. Regulation is extremely favorable. I think what we're really missing is a catalyst, right? And I can't really pinpoint it where that's going to come from this year, but I think with the new Fed chair, the policy around there's been a lot of turmoil, especially out of the White House. But with the U.S. government shutdown, the liquidity kind of been sucked out of that market and the capital markets in the U.S. And I think there's going to be a mean reversion between what we've seen in silver and gold and Bitcoin. So look, it's about weathering the storm. I think there's enough asset managers out there that know how to manage risk. So I think you should have the conversations now. Because the opportunity is actually huge.
Absolutely. I remember a data point from BlackRock that I saw that surprised me was 4% of baby boomer millionaires hold crypto, 82% of millennial millionaires hold crypto. So we are going to see a wealth transfer from the oldest to the younger generations. Those people are going to want some crypto in their portfolios. This is going to happen. So people need to have some offering in crypto to be able to fill those requests, or they are going to lose clients. And also the type of price appreciation we've seen in gold, in silver, gold going from 12 trillion to 36 trillions in a very short space time. A very, very, very small rotation from that asset class to Bitcoin could have a very huge impact in the short term. Talking in terms of flows, fundamentals are really, really going in the right direction.
I guess ultimately it's the fear of missing out. If your competitors have made money in digital assets and you haven't, it could put you in jeopardy ultimately. And having a small part of your portfolio allocated to it at least gives a good talking point if it does well, and if it doesn't, probably really makes no difference to your total return anyway.
Fantastic. I think we're out of time. We appreciate everyone here, and hopefully we can keep this conversation. Thank you so much.
Thank you very much.